The biggest trade of the century is now an ambush. Michael Saylor's $54 billion Bitcoin bet hit a Wall Street kill switch. Mark January 15, 2026. Nasdaq plans a targeted deletion that could trigger a $200 billion forced sell-off. This isn't just about one stock. See how they set the trap? The 54 billion kill switch. 54 billion. That's the score. Michael Saylor just pulled off one of modern history's greatest trades, outsmarting the financial establishment. His company, Microstrategy, controls 649,870 Bitcoin. That's over $54 billion in digital gold, making Microstrategy the largest corporate holder of crypto on Earth. Think about it. An unknown software firm now owns more Bitcoin than many nations. Saylor didn't gamble. He engineered a market cheat code. Microstrategy became the loophole. Institutional investors, unable to buy Bitcoin directly, bought MSTR stock, a legitimate way to ride crypto via Nasdaq. Pension funds, hedge funds, they piled in. MSTR went parabolic. Saylor found the glitch, delivering massive returns. Wall Street should celebrate. In America, we reward vision. We reward winning. But here's the brutal truth you need to understand. The Nasdaq 100 Index Committee doesn't see a visionary. They see a problem. Microstrategy committed a cardinal sin, holding over 50% of its assets in one investment, Bitcoin. Saylor broke their sacred diversification rules. The irony? The man makes the trade of the century, turning shareholders into Bitcoin millionaires. His reward? Deletion. The establishment labels his company toxic, kicking it out. To them, this isn't success. It's a dangerous mono-risk violation threatening their system. This isn't subtle. Financial institutions don't politely ask. They delete you. Deletion from a major index like the Nasdaq 100 ripples through the system. Look at January 15, 2026. That date is circled in red. It's when the Nasdaq 100 Rebalancing Committee meets. For Microstrategy, this isn't routine. This is financial catastrophe. Here's how they pull the trigger. Trillions in passive funds, like the $200 billion QQQ, mirror the Nasdaq 100. These aren't human managers. They're robots, programmed to own exactly what the index owns. The moment Microstrategy is removed, every passive fund gets an automatic command: dump the stock immediately. Institutional computers execute market sell orders, regardless of price or liquidity. JP Morgan's analysts warn of a liquidity trap. Primary buyers vanish instantly. Imagine selling your house, but every real estate investor legally stops buying. The market doesn't just go down, it disappears. Now, Saylor's empire is vulnerable. He didn't build this $54 billion Bitcoin position with cash. He used aggressive financial engineering, convertible notes, loans from institutional investors convertible into MSTR stock. This worked while the stock climbed, but this structure depends on MSTR stock liquidity. If forced selling collapses the price, convertible notes can trigger immediate repayment. Where does Microstrategy get cash? Its primary asset, Bitcoin. Volatile, illiquid, at massive sizes. Saylor can't just sell $50 billion in Bitcoin. That crashes the entire crypto market, triggering more debt, forcing more Bitcoin sales. Financial professionals call this a death spiral. Each forced action worsens, accelerating decline. The timing is cruel. January 15th is a hard deadline. If Bitcoin holdings still represent over 50% of Microstrategy's assets, deletion is automatic. Saylor knows this. Every major institution knows this. He could sell Bitcoin, but that likely crashes the price anyway. What company is large enough to offset $54 billion in Bitcoin? The trap is set. The mechanism in motion. On January 15th, they pull the trigger on what could be the largest forced liquidation in crypto history. But this isn't just about a broken rule. It's about a kill switch designed to trigger a catastrophe. And there is one piece of evidence that proves this was a trap from the very beginning, which I'll reveal at the end. The Deletion Mechanism. Kill switch. I'm Jordan Blake. I've spent over 10 years researching the mechanics of financial crises and market bubbles. I'm going to be walking you through exactly how this situation impacts your money. And what I'm seeing in Michael Saylor's situation is a pattern I haven't seen since the forced liquidations of 2008. Being deleted from the Nasdaq 100 isn't a slap on the wrist. It's the trigger for a catastrophic, automated forced selling event that operates with machine-like precision. You need to understand this. There's a date circled in red on every major financial institution's calendar right now, January 15th, 2026. This is not a possibility, it is a deadline. That's when the Nasdaq committee will meet, and if Microstrategy's Bitcoin holdings still represent over 50% of the company's assets, the deletion becomes automatic. Now, the Nasdaq committee will tell you this is about diversification rules, about protecting investors from concentration risk. They'll claim it's standard procedure, but look at the data. Michael Saylor turned his company into a cheat code for institutional investors, a way to gain crypto exposure within the traditional stock market. Pension funds, hedge funds, money managers, they all piled in. He found the glitch, and for that, he's being punished. This isn't about protecting you, it's about control. Here's how the mechanism works, and this is where it gets truly disturbing. Trillions of dollars in passive index funds and ETFs are hardwired to mirror the Nasdaq 100. The biggest one you've probably heard of is the QQQ, managing over $200 billion in assets. These aren't managed by human brains. They are financial robots, programmed with one simple instruction: own exactly what the index owns, nothing more, nothing less. So, the moment MSTR is officially removed from the Nasdaq 100, these funds receive an automatic, non-negotiable command to dump all shares, regardless of price. We're not talking about a gradual sell-off. We're talking about institutional computers executing market sell orders with machine-like indifference to price, to liquidity, or to market conditions. When you place a market sell order, you're saying sell it now at any price. When hundreds of millions of shares flood the market, that's not a market, it's a financial black hole. JP Morgan's internal analysis calls this a liquidity trap, and that term should send shivers down your spine. Right now, the primary buyers of MSTR shares are these massive index funds, required to own the stock because it's in the Nasdaq 100. But the moment deletion happens, these mandatory buyers instantly vanish from the market. Imagine trying to sell your house, but every potential buyer in the city is suddenly legally forbidden from making an offer. The market doesn't just go down, it disappears. This forced selling is just the first domino. The real vulnerability lies in how Saylor built his empire, a financial structure that turns from a work of genius into a death trap the moment the market turns against him. The debt spiral. It wasn't cash that built Michael Saylor's Bitcoin fortress. It was billions in convertible debt, a brilliant strategy in a raging bull market, now poised to become a doomsday device in a forced liquidation. You need to understand this. Look at Microstrategy's financials. They hold 649,870 Bitcoin, a $54 billion treasury at recent prices. But this isn't free money. Saylor used sophisticated financial engineering, issuing convertible notes. These are essentially loans from institutional investors, with the option to convert them into Microstrategy stock at predetermined prices. It's a genius move when your stock is parabolic, but it's a ticking time bomb when the market turns. The Nasdaq 100 Index Committee sees Saylor's concentrated 50% Bitcoin holding as a cardinal sin. They're preparing to delete him on January 15, 2026. I know what you're thinking. So what? It's just an index removal. But this isn't just a membership card getting revoked. It triggers an automatic, non-negotiable forced selling event from passive funds. Trillions of dollars in ETFs, like the QQQ with its $200 billion in assets, are programmed to mirror that index. The moment MSTR is out, these institutional robots dump the stock without regard for price or liquidity. Here's where the trap springs shut. These debt agreements contain protective covenants. If Microstrategy's stock price collapses below certain thresholds due to this forced selling, lenders can demand immediate repayment. Now, the critics will argue Saylor can simply refinance or raise equity. But who lends to a company whose stock is in freefall and whose only major asset is a volatile, illiquid cryptocurrency? Who buys equity in a market destroyed by forced selling? No one. That leaves only one option. Michael Saylor is forced to sell his Bitcoin. But selling $54 billion in Bitcoin is like trying to drain an ocean with a teacup. The market doesn't have that liquidity. Selling even 10 or 20% of Microstrategy's Bitcoin position in a compressed time frame would overwhelm global markets. This creates a death spiral. Forced MSTR selling crashes the stock, which triggers debt calls, which forces Bitcoin sales, which crashes the crypto market, which crashes the stock further. There's no circuit breaker for this. It's a mechanism designed to annihilate. This spiral isn't just a threat to one company. It's designed to cascade through the entire crypto ecosystem. And when you see who is waiting with billions in cash to pick up the pieces, the attack becomes terrifyingly clear. The Bank Heist. They lied. Markets aren't free, driven by innovation. Michael Saylor's victory is being weaponized against every American holding Bitcoin. This isn't an accident of market mechanics. It's a strategic, coordinated attack by the legacy banking system to engineer a crash and seize control of the Bitcoin market. You need to understand, Bitcoin fundamentally threatens the legacy financial system. It's decentralized. Banks can't print it, can't control its supply, can't extract fees. This asset undermines their entire wealth extraction model, perfected over centuries. Wall Street watched, alarmed. They couldn't ban Bitcoin outright, exposing their true colors. They needed an elegant solution, control without open attack. And Michael Saylor handed them the weapon. Look at this. Saylor's company, Microstrategy, controls 649,870 Bitcoin, a $54 billion score. He made it the largest corporate holder. His firm became a cheat code for institutions, allowing crypto exposure via a Nasdaq-listed company. Pension funds, hedge funds, all piled in. He built a massive concentrated position using aggressive financial engineering, convertible notes, essentially loans with a catch. This looked brilliant during a bull run, but as JP Morgan's analysts warned, it created a liquidity trap, a kill zone. They let him march right in. The Nasdaq 100 Index Committee sees Saylor not as a visionary, but a problem. His cardinal sin, holding over 50% of company assets in one investment. Diversification rules broken. Punishment is coming. Deletion. The date? January 15th, 2026. Not bureaucracy. Catastrophe. When Microstrategy gets deleted from the Nasdaq 100, it triggers an automatic, non-negotiable, forced selling event. Trillions in passive funds, like the $200 billion QQQ, mirror that index. These are robots. They dump stock immediately, not strategic. Institutional computers execute market sell orders, indifferent to price or liquidity. Imagine selling your house and every buyer vanishes. The market doesn't just go down, it disappears. This is where the trap snaps shut. As MSTR stock collapses, convertible note lenders get nervous. Their investments lose value. Loan agreements allow immediate repayment if stock falls too far. Where does Saylor get cash? Traditional financing gone. One asset, Bitcoin. But he can't sell $50 billion worth easily. The market is illiquid at that scale. Even dumping 10% to 20% of his 649,870 Bitcoin would overwhelm global liquidity. This creates a death spiral. Forced selling triggers stop loss, margin calls, more selling, a flash crash. 50% of Bitcoin's value could vanish in hours. This is what you face. Now, critics say, Jordan, this is market risk. Saylor gambled. They're wrong. This isn't normal market dynamics. This is a system where bureaucratic rules trigger automatic liquidations designed for wealth transfer. Who buys when Bitcoin crashes to $40,000 or $50,000? The same major banks and financial institutions quietly building crypto infrastructure while publicly scoffing. They acquire in weeks what took Saylor years. They don't just win, they weaponize his strategy, stealing assets from crypto holders, transferring them to Wall Street. This is the bank heist theory playing out in plain sight. No conspiracy, just perfectly executed rules. Saylor bet everything on Bitcoin. That success is now being used against him, making him the mechanism of his downfall and yours. They set the trap. The date is on the calendar. So what does this mean for every American holding Bitcoin, and what is the final signal that proves this was their plan all along? The verdict. Michael Saylor pulled off the trade of his life. His Microstrategy now holds 649,800 Bitcoin, over $54 billion. MSTR became the cheat code for institutional crypto exposure, its stock outperforming everything. But the Nasdaq 100 committee sees a problem. The Nasdaq's rulebook states a cardinal sin: over 50% of assets in one investment. Saylor broke it. His reward? Deletion from the Nasdaq on January 15, 2026. This isn't a rule violation, it's the activation of a kill switch. You need to understand this mechanism. Trillions in passive funds, like the 200 billion QQQ, mirror the Nasdaq. MSTR's deletion triggers immediate programmed dumping. Institutional computers execute market sell orders without price regard. JP Morgan warns this creates a liquidity trap. Primary buyers vanish. The market disappears. Saylor's empire rides on billions in convertible notes. Brilliant in a bull market, but index deletion collapses the stock. Lenders demand immediate repayment. Where's the cash? His stock is worthless. His primary asset is volatile Bitcoin. This is a death spiral. Forced action triggers more selling. No circuit breaker exists. The index rules are absolute. This attack on Saylor is a proxy war against all crypto. Every Bitcoin holder is in the crossfire. The legacy system weaponizes bureaucracy. Critics say this is standard risk management, but look deeper. Banks publicly denounced Bitcoin for years. Secretly, they spent billions building institutional infrastructure. They built the buy side for the crash they planned. This isn't risk management, it's a trap. The risk to you, the individual investor, is profound. If Saylor sells even 10% or 20% of his 649,870 Bitcoin rapidly, it overwhelms global liquidity. The price won't just decline, it will flash crash, a cascade wiping out 50% or more of Bitcoin's value in hours. Your portfolio's crushed. This isn't theory. It's the mathematical consequence of $54 billion in illiquid assets forced into liquidation. This isn't financial advice. It's a warning. The math doesn't lie. They are coming for the assets of the future. The legacy system will not surrender control. They let Saylor accumulate, creating a kill zone. Now, a simple rule change triggers forced liquidation, crashing Bitcoin to $40,000 or $50,000. Who buys then? The same banks that dismissed it. This isn't just deleting Saylor, it's a coordinated wealth transfer, using bureaucracy to redistribute billions in Bitcoin from believers to institutions seizing future money. The countdown is already running. When that deadline arrives, we're all going to find out whether Michael Saylor's Bitcoin bet was the trade of the century or the setup for the greatest market manipulation of our generation.